Good morning, everyone. This is Aaron from Netwealth. Thanks for coming along to our Netwealth educational webinar today. Today we've got Theo Maas from Arnhem Investment Management, who will be presenting to us why it's not all about Facebook, Amazon, Netflix, Google and Apple stocks when thinking of investing globally, and more specifically why advisors need to consider other global growth industries when thinking of investing globally. Now, just before we start, just a couple of housekeeping things. First of all, the webinar will be recorded, and then a slide and a recording of the webinar will be sent to you after the webinar. If you do have any questions, feel free to put them into the question box in the GoToWebinar panel, and then we'll try and get to your questions at the end of the webinar. If you are posting on social, make sure to use hashtag NetwealthInvest and also at NetwealthInvest. There is CPD points for this webinar, and we will be sending a questionnaire after the webinar. And once you successfully complete the questionnaire, you can download your CPD cert straight away. Now, a bit of background before we start, just a bit of background on Theo, she's the presenter today. Theo manages the global equity SMA strategies at Arnhem. Theo has been professionally active in the market since 1994. Starting as a fixed income specialist, he soon realized that his real passion is reserved for the equity markets, where translating industry and company prospects into stock returns is the biggest and most interesting challenges of all. Since 1997, Theo has been active in various roles in global equity markets for ABN, AMRO, and with a strong accent in technology, media, and telecom sectors. After doing that for 10 years, Theo decided to join Arnhem, and at Arnhem, he's helped to further encourage the team to broaden its horizon by looking globally for the best industries and companies, which resulted in the launch of 2 global equity SMA strategies in Jan 2015. So without further ado, I'll hand over to Theo, who will be presenting today.
Great, thank you very much, Aaron, and thanks Netwealth for the opportunity to talk about a topic that we are all very excited about at Arnhem. So today we're going to talk about the what we call the FANGA stocks, and I'll explain what we mean by that, and the obsession of the financial press with those stocks, because in our view the world is a bit bigger than just 5 stocks, and we're going to talk about 2 opportunities that throw out a lot of potentially interesting industries. The first one is the automotive sector, and the second one is all about virtual and augmented reality, and I'll talk you through that to talk you through it. We'll finish with a short word from the sponsor, and I'll open it up for Q&A. So the FANGA stocks. Now, if you believe the AFR, there are just 5 stocks listed outside of Australia. Facebook, Amazon, Netflix, Google, or Alphabet, I should say, and Apple. So typically, the press will call them FANG stocks, but I'm happy to include Apple here as well, which is normally excluded, and call it FANGA. Now, as you can see from the chart there, these stocks have had a spectacular run since the last 2 years, averaging about 91%. The only laggard is actually Apple. That might be the reason that Apple has been excluded from the FANG acronym in the first place. With that run, they've actually added about $600 billion worth of market cap, and they're now larger. So the 5 of them combined are more than $2 trillion in market cap, which actually makes them larger than the Italian GDP and pretty close to the UK GDP as well. So we're getting there. Now, we don't actually believe that this run will continue, and I'll explain to you why Alphabet or Google is actually the only one that we like. But before I go there, I just want to address the Donald in the room. Normally at this point I would now ask for a minute silence, but Netwealth advised me that that probably doesn't really work for a webinar, so let's not do that. So the eagle-eyed among you will have spotted that the chart that I've put up here doesn't include the post-election effect that we've seen after Donald Trump was elected, because the FANGA stocks actually got hit quite a bit. Now, whether that is correct or not remains to be seen. In my view, there's good Donald and there's bad Donald. Good Donald basically means lower company taxes, foreign cash repatriation at no or low taxes, which is a big thing for these tech stocks, and obviously this whole debate about significant infrastructure spending. Now, I'll leave aside all the adverse effects that will have on the U.S. budget and the U.S. debt position for the moment, but let's call that good Donald. Now, bad Donald is really all about trade wars, import duties, and the whole debate about outsourcing to low-cost countries, because keep in mind that especially companies like Apple completely depend on outsourcing their manufacturing to low-cost countries, so they'll be heavily impacted. And also keep in mind that CEOs like Jeff Bezos from Amazon, who actually owns the Washington Post, by the way, and has been very critical about Trump, and the same goes for Tim Cook from Apple. They've been pretty active out in the press, basically campaigning against Trump. So whether that will come back to haunt them, we'll see. So let's start with Alphabet. It's actually the only one out of the 5 that we really like. In discussing all of these 5 stocks, I will discuss the industry position, the company position, and the valuation of the stock. It's a typical way for us of looking at stocks. So Alphabet, or the artist formerly known as Google, is basically involved in all industries related to online advertising, and the main driver is really their core business, which is search-based advertising. It's really the crown jewel of the company. I don't know anyone that still uses Bing, but maybe someone on the call still uses it and would like to share that with us. Would love to see that, but again, don't know anyone there. Now, the big growth in Alphabet has really been all about video. As you might remember, they bought YouTube in 2006. They spent $1.6 billion on them, and that was considered outrageous at the time because YouTube was 18 months old, hadn't produced any profits whatsoever. So they basically got criticized a lot for buying that. Now, we're now 10 years later, and on most people's numbers, if they split out YouTube, they'll probably value it at around $150 billion at the moment, out of the $600 billion of market cap that Alphabet is. So I would say this is probably one of the best acquisitions in corporate history. And the reason why is simple. Anyone who has teenagers as children will know that they spend a lot of time watching videos. And spending a lot of time watching these videos means that the value of the advertising goes up, because that obviously attracts a lot of advertisers, and that's really what's been happening. Now, the next growth area is all about mobile. That doesn't only impact Alphabet, but it impacts everyone. Typically 60 or 70% of current data traffic now is generated by smartphones and tablets. So that really brings a lot of new opportunities, but also a lot of new challenges, like trying to come up with new advertising models, because the old traditional way with banners and the like doesn't work on such a small screen. The only real miss that Alphabet has had over the last 10 years is not being involved in social media. And that's not for a lack of trying. They've come up with this Google Plus, which has been an absolute disaster. Basically, Facebook has run away with this this whole market, which is a shame because it's one of the fastest growing markets around at the moment. So for Alphabet, it really comes down to acquiring a company to get started again in this space. And the problem is that there's not that many alternatives. So the only real alternative at the moment is a company called Snap, who are the makers of Snapchat, as some of you might know. But Snapchat is about to IPO, and they're asking for about 25 billion. So this is not going to be a cheap entry into this space. Now, on every slide going forward, I've included a valuation sheet as well. So if you turn to the the bottom right part, you see in the blue line you'll see a PE ratio, and in the green line you'll actually see the EPS over the last 10 years of the company. Now, the chart for Alphabet is basically like a dream. I mean, with EPS going up every year consistently, there's not that many companies around that show this structure. And at the moment, you're paying around 20 times for it, which I think just significantly undervalues the company. So as you might have guessed, we really like Alphabet. Moving on to the next one, Apple. Probably a bit more controversial because I don't really like it. And it's all based on the old saying that a great company doesn't equal a great stock. I probably spend about 20% of my own salary on Apple products, and I love them. I just can't get myself to buy their shares, and that's really the difference. Now, I've been looking at Apple probably for around 20 years now. In the mid-90s, I've sold a lot of stock at $5, so I'm not quite sure if you have to take me that seriously on Apple, but anyway, I'll give it a go. So the smartphone industry really has been a lot more competitive ever since Nokia died. So we're seeing the usual suspects, the Apples, the Samsungs, the LGs, the Sonys. They continue to battle along for market share, but they've been joined by a long list of new, mainly Chinese players like Huawei, Oppo, and Xiaomi. It's also clear that Apple's operating system called iOS is losing share versus the rest of the market, which is all on Android. Now, the good thing for the market itself is that the likes of Symbian, which was Nokia, and BlackBerry and Microsoft have mostly disappeared. So it is from that perspective, a two-horse race. But yeah, again, Apple is losing that race at the moment. Now, the other problem I have is that replacement cycles have continued to lengthen. And what I mean by that is that really there's no real reason to buy a new phone every year like there used to be because they were so exciting. The fact that you've got a smarter processor in there or a better camera is probably not good enough reason to spend another $1,000 to buy a new phone every year. And that's what's happening. So the typical replacement cycle has gone to 2 years or more, and that's well up from recent years. So that doesn't really bode well for the industry as well. Now, if you look at company level, Apple is completely dependent on the iPhone. That's about 70% of their profitability. And ever since they launched it in 2007, that has completely transformed the company into the $600 billion giant that it is right now. So this issue with the smartphone industry is really an industry issue for Apple and is impacting their business a lot. So what's next? Now, a lot of people have talked about new exciting products coming out of Apple. And the iPad did change the dynamics a bit for a couple of years, but it's in decline at the moment as well. And the old PC and notebook business for Apple is now really a niche business. It's a rounding error versus the iPhone. So you really started talking about things like the Apple Watch. Now, again, if you talk about a rounding error, the Apple Watch is one. Talk about cars or TVs, and you quickly consider the fact that Apple doesn't have a lot of interesting stuff in the pipeline, which worries me a lot. Now, the bulls will continue to talk about iCloud or services in general, but that's really, in my view, a little bit too me too, because if I look at Amazon or Microsoft or Google or Spotify, they're just well ahead in terms of this business. Yeah, that really leaves the question: is this a value trap or not? Now, in my view, it is, and yes, it's trading at a low PE. It's trading at 12 times, and you can see the chart there as well. You see the EPS chart is starting to go backwards a little. 2016 was actually the first year, and the year ended in September for Apple. Was the first year that that revenues and earnings went backwards, and earnings went backwards by 10%. And I don't think that's going to stop anytime soon, based on that view. So happy to stay clear from Apple. I move on to Amazon. That's a bit more mixed, and that's really about the fact that I like the Amazon Web Services business. I just don't get overly excited about the retail business. Now, it's clear that they've dominated internet retail, and I think internet retail will continue to grow because simply the penetration of it is really low in most countries. The fact is only that even after 20 years of doing this, Amazon has completely dominated it, but still struggles to get more than a 3% profit margin. And you can see on the EPS line as well, that's been all over the place basically, and that's really down to the fact that the combination of growing this business and making good margin is a really hard one, and Amazon has struggled with that. So the interesting part of Amazon is really AWS, or Amazon Web Services, which is the cloud services business. And that's just been growing like crazy, and all driven by the Netflix effect, so i.e. a lot of data growth driven by video. That's been an excellent performer for Amazon. The problem is it's about 10% of sales or about 25% of profitability. So it doesn't really move the dial that much yet for Amazon. So to buy it, you have to be a believer of Amazon as an internet retailer, and I'm just not there yet. Now, on the question of whether Amazon will launch in Australia, I'm a firm believer that they will. In all likelihood, that will happen next year. And that will have a serious disruptive impact on all the local existing brick and mortar retailers. So watch out for that one. Next one, Facebook. Now, this is one I'm trying to like, and I'm getting there, but I'm not there yet. And that's really comes down that the multiple of Facebook has come down a lot, as you can see in the blue line in the chart. Facebook, as we all know, has dominated the social media business, and they've basically bought any potential competitor with people like Instagram and WhatsApp. So the only real competitor at the moment is Snapchat, and the Chinese players like Tencent and Alibaba. But those guys have never been able to get out of Asia, basically, in terms of being successful. Now, the fundamental problem I have with Facebook is really about monetizing your customer base without losing them. And what do I mean by monetizing? It's all about either getting them to pay for services or getting them to watch ads enough so that they make the money from that side. And that's where they make most of the money at the moment. Now, we all know that these social media people are a fickle bunch, and I'm sure you all remember MySpace, a very successful acquisition by News Corp. These people, and I call them the cool crowd, they leave pretty quickly if they feel that they're being overburdened by ads or having to pay for stuff. And keep in mind as well that this is a bit of a generational issue. The millennial generation really is not used to pay for stuff. So if you start charging them for stuff, they typically walk away to the next free one. Yeah, the multiple, as I said, has come down, and we're getting to more realistic territory. We're now slightly below 30 times, but I'm not there yet. Again, I don't think that these risks have been priced in so far. Which leaves the final one, and my least favorite one, called Netflix. Now, again, Netflix, everyone knows, subscription video on demand. This industry has basically come out of nowhere. And will typically in most countries, and Australia is no different, you'll see 2 or 3 competitors that do exactly the same. And it had an impact on the pay TV industry as well, where terms like cord cutting or cord shaving have been used a lot. And what people mean by that is really if you pay your $130 for Foxtel Platinum, you'll probably be tempted to either lower that package, i.e. skip the movies or skip anything else and take a Netflix for $10 a month, or you'll cancel your Foxtel subscription altogether. And that's mostly for people like me who are not overly interested in NRL or AFL. So that has an impact on the pay TV industry as well. Now, there's two big problems that I have with Netflix and with the industry in general. The first one is the price of content. Now, the fact that there are many bidders for content, and all these competitors out there, plus the traditional media guys, are all bidding for the same rights. The price of content has gone up significantly in recent years, and we've certainly seen that in all the sports codes. And certainly with the ones that go global, like the English Premier League, for example. The other issue with content costs is that to stand out, you really need to have original content these days. Now, that's not cheap either. Keep in mind that Netflix, for example, spent $100 million just on the first season of House of Cards. Obviously a big hit for Netflix, but they paid up for it. Kevin Spacey, by the way, got 30 million of that, so he must be happy. Now, the other potential threat for the whole industry is what is called typically net neutrality. What I mean by that is that Netflix has basically had a free ride in terms of the infrastructure that they use. Every telco in the world has had to spend a lot of money, a lot of capex to upgrade their networks, because people have started to use more and more based on Netflix and the likes. Now, the telcos have paid for this. Netflix hasn't had to pay $1 for this. Now, this is all based on something that is called net neutrality, which is really government driven, and really is telling you that the government is basically forcing them to not discriminate on the data stream. So whether it's a phone call you're making over the internet, or whether it's a Netflix stream, telcos are not allowed to discriminate and not allowed to charge differently for those data streams. And that has really helped Netflix moving along. Now, the problem is that Donald Trump has openly been not a big fan of net neutrality. So if that changes, that has a big impact on the whole industry. Now, from a company and a valuation perspective, Netflix has really been struggling to become profitable. You can see the green line there all over the place with EPS being from very positive to very negative. The problem is that the growth outside of the US has cost them a lot of cash, and that is continued to be shown the case, as you can see in the chart above there, with the red line showing the international customers. So we've now talked about the 5 FANGA stocks. I think there is a lot more interesting stuff going on outside of these 5 stocks, and I'll talk about 2 specific sectors or trends here. And the first one is all about automotive, which used to be quite a sleeper, but there's 3 drivers basically that are completely changing that sentiment in the sector. The first one is all about emissions and emission control. Then safety, and the third one is the most exciting one, is if you talk about autonomous cars and on-demand mobility. So let me run through those 3 different drivers. The first one, emission control. So we know greenhouse gas is a problem. We know that cars are a material contributor to that problem. Hopefully we can convince Donald as well that this is a problem, but most people agree that it is a problem. So as a result, emission targets have been set around the world, so we need to do something about it. Now, the cheapest way of doing it is to use advanced technology in cars. Things like 48-volt batteries or direct injection are a very simple way of reducing emissions, quite straightforward. And all these technologies cost money, but with scale, they typically come down in price and become mainstream pretty quickly. The more effective but the more expensive way of doing it is actually changing the powertrain, as it is called. So it's basically going from a traditional combustion engine to an electrified powertrain, and either combine that as in hybrid or go fully electric. Now the big problem here is really that the battery costs have been exorbitantly high, and the downside for consumers, things like long charge times, limited range, very few charging stations, have all made this quite difficult to introduce. The final one, weight reduction, is probably a bit in the middle there. It's easy to achieve, but the materials that are used, things like carbon fiber, reinforced plastic, are still quite expensive. So you only see that in very expensive cars. Now, the one company that's really exposed to it obviously is Tesla, and I'm not a big fan. And that's nothing to do with potential competition from the likes of Mercedes and BMW, who are all working on this. That's all got to do, in my view, with the internal production promises that they've made. I'm very skeptical about the ability of Tesla to deliver 500,000 cars in 2018, which is only a year and a half away. And that is simply because they've never done that, and we know from practice that this is quite hard to achieve. And certainly with battery costs not going down rapidly enough, that is a bit of an issue. Now the next driver is all about safety. We all know that seatbelts and airbags have done a lot of good work, but there's still 1.25 million people that die in road accidents every year. By the way, the US is a lot worse than most other developed countries. And here it's also a question of technology. So if you start introducing things like ABS, which are now in most cars, or electronic stability control, safety actually becomes better, or less people die. The exciting thing is that you can take this a lot further, and that's something called Advanced Driver Assistance Systems, or ADAS. It's really a combination of cameras, sensors, and chips to really make sure that you know what's going on inside and outside the car, and that's the exciting part. Now, how do you play this? How do you invest in this? You can look at a company like Continental, which is one of the leaders in ADAS systems. And it's really all about the electronic componentry moving up from about $300 a car at the moment to likely tripling in the next 2 years or so. So that's actually quite an exciting growth opportunity. The final one is all about autonomous cars and on-demand mobility. Now, you all know about Google and Tesla working on fully autonomous cars, and the next time you're driving in downtown LA, you might actually bump into an empty car next to you. That might be a Google car. But the reality is that there's a lot of commercial and legal hurdles to be taken. So in all likelihood, we'll see semi-autonomous taking off much more rapidly. The other trend here is all about on-demand, and that's really what Uber has been doing, changing driver behavior by not having to own a car anymore. Now, if you start combining those two trends, things get really excited. Just imagine calling for a fully autonomous car and just sit in the back and do nothing while on your way to your destination. Now, I'm sure that the media industry will be all over this because suddenly that opens a whole lot of free time that used to be behind the wheel. So I think they'll work on more cat videos and Kardashians to fill up that time. Now the next trend I would like to talk about is all about a new reality, and whether you like this reality or not, it's going to happen. A new reality is all about augmented reality and virtual reality. So I'll explain what the differences are, and I'll go through the Pokemon example as being one of the first mainstream users of it. And then finally, we'll discuss a few of the interesting industries that might be exposed to this trend. So let's start with defining what augmented reality and virtual reality actually is. Now, augmented reality, it's blurring the line between the real and the digital world. It augments reality with a digital layer. You can see the top photo on the right hand side showing an example of that. You typically need a smart screen to do that, and that's pretty much it. Now, virtual reality is really taking it a step further. It's really replacing the real world with a digital one. And to be fully immersed in this world, you really need to cover your eyes and ears, and that's typically done with a special headset. And again, Samsung was kind enough to provide an example in the lower photo there. The biggest difference between the two is really the hardware that you need. And while a lot of people seem to connect this to gaming, and that's really an obvious example of both augmented and virtual reality, I think the applications are a lot deeper than that. If you just imagine the following scenario, that you're looking for a new couch. Now, normally you had to go to one of those bloody Harvey Normans, wait to get parking, screaming kids in the back, stand in line, etc., etc. Now you and your wife or husband, you're sitting literally on your existing couch. You put your goggles on. You log on to Amazon Australia, given the fact that that will be launched next year, and basically you start looking for your new couch. Now you can play around with fabrics and colors. You can move that couch in your own living room and pick your favorite spots, and finally you click the buy button. You're done. So that's all a bit more excited than, again, going to Harvey Norman, in my view. So let's talk about Pokemon Go, because that was a big hit and still is. Basically, it's tens of millions of people still playing it, which is really the first mainstream use of augmented reality. And the exciting thing is that it took just a smartphone which has a GPS and a camera on it to start using it. So it's really in the hands of literally billions of people that have a smartphone like this at the moment. Now, it's almost like a new tulip bubble. Investors all made the mistake that Nintendo is the only beneficiary here. Now, unfortunately, Nintendo is only a small investor in the two companies that are behind this technology, which are Pokemon Company and Niantic, which was actually a Google spin-out. But it does show, again, the fact that AR or augmented reality is really around the corner. Keep in mind as well that Nintendo still has Super Mario up their sleeve as well. So on your next Sunday morning paper run, you might bump into a few people chasing Mario. The next slides really talk about industries that are exposed to both AR and VR. And the first most obvious one that are typically used as examples are the gaming console guys versus the gaming content or the video games guys. Now, the console market has a long history of non-profitability. It's been a pretty awful market to be in. And it's like a Gillette model trying to subsidize hardware without and trying to compensate it with selling software. Not an industry that I'm overly excited about. What is more exciting is the gaming content market, and it's really that has grown into to become a $100 billion market at the moment, and it's dominated by two players, Activision and Electronic Arts. Now, the beauty is that they all have franchises, and whether that's Call of Duty or FIFA or whatever they use, which are all being used over and over again, and they've learned that playbook really well from the existing media guys. So that's a really interesting usage of new technology here. The next potential industries that might be exposed there are more deeper down in the food chain of this whole phenomenon, and it's all about semiconductors here. So every AR or VR system, especially VR is very hungry in that perspective. They all need a lot of memory, CPU and GPU. The memory market is not a pretty one from an investment point of view. It is really all about commodity products which use a lot of capex to be produced. So just as an example, Samsung, one of the big players in memory, has just opened up their latest factory, and they spent $14 billion on building that factory. That's how capex intensive this industry is. So it's all about scale and commodity, not a pretty side in general, and typically more trade than an investment. So what about the CPU, or the central processing unit? Now, this is all Intel basically. Intel dominates this market. The problem for Intel from this perspective is that the typical virtual reality box does not really rely on a lot of processing power from a CPU point of view. So that's typically not the weakest link. So Intel is not the most obvious beneficiary from this market. Who are benefiting? It's really the GPU, or the graphical processing unit guys, and this market is dominated by NVIDIA. If you are looking for a weak link in any of the VR systems out there, it is typically the GPU. And that's the reason why all these existing VR systems are very expensive, because you need to hook them up to very big supercomputers to get the full VR experience. So a very interesting growth market for a company like NVIDIA. So with that, I'll do a short word from our sponsor, i.e. Arnhem, and talk about the Arnhem SMA solutions on Netwealth. Now, we're really excited to offer two models on the Netwealth platform, and they both have been specifically designed for Aussie investors. So depending on your own situation or that of your client, you've got Aussie Plus, which is a blended portfolio offering both income and growth. And then there's Global Growth, which is a 100% global growth portfolio that invests in industries that are not available on the ASX. If you want to discuss any of these models, please let us know. We're based in Sydney, but we're happy to come to your office. And with that, I'll open it up for any Q&A.
All right, thanks, Theo. We do have a number of questions that came in throughout the session. The first one being Twitter and LinkedIn. So essentially we spoke a bit about tech stocks like Facebook and Google and such. What are your thoughts on Twitter and LinkedIn, and whether that would be part of,
Yep. Let me start with the easy one, LinkedIn, because that's basically gone. The company has been bought by Microsoft. So to get access to LinkedIn, you really have to buy Microsoft, and I think it's well hidden within Microsoft, and I think that is the place where it will probably die as well, because it will typically be integrated in the Microsoft Office suite. Interestingly, Salesforce.com was the other big bidder for LinkedIn, and unfortunately they lost because I think the combination between Salesforce and LinkedIn would have been a lot more interesting for investors going forward. So that's LinkedIn. On Twitter, yeah, that's a tough one. I just think that this is a platform that is in structural decline. And they have been struggling. They have been trying to sell the business, and there's been a whole list of potential contenders that have been dragged around in the press, but none of them have basically been biting the bullet so far. So if we look at Twitter and we look at the fundamental data there in terms of usage, in terms of users, things are not looking pretty. So I think that the end result for Twitter will be that someone will buy them, but I'm afraid for Twitter that will be at a lot lower level than at current share prices.
Cool. So the next one is around Alibaba. As we all know, there was a big news when Alibaba, which is the largest e-commerce site, one of the largest e-commerce sites in the world, went public in the States. So what again? What are your thoughts on Alibaba and the prospect of that company? Is it overvalued at the moment?
Okay.
And,
Yep. Yeah, Alibaba is an interesting beast in the sense that they do a lot. It's almost like a combination of Amazon, Facebook, probably LinkedIn as well, eBay. So they're involved in a lot of business and obviously very successfully so. The biggest problem I have is that the sell side or market expectations really show Alibaba growing successfully outside of the Chinese or the greater Asian market, and so far they've struggled to do so. Now there's lots of interesting components within Alibaba, and maybe at one point we'll get access to those. And again, one of the more interesting one is a company called Ali Cloud, which is really a copy of Amazon Web Services. And again, I'm very excited about that space. So hopefully we'll get our hands on that one as well. But as a conglomerate and with the current market expectations out there, not overly interested.
Cool. And the final question is around peer-to-peer economies, stocks around peer-to-peer economy, which has experienced significant growth in the last couple of years. So we're talking about companies like Uber and Airbnb and such. There are rumors that there's been rumors that eventually they have to go IPO one day, and they have been valued at ridiculous kind of numbers like 40 billion or something like that for Airbnb, for Uber. So I guess just obviously just whether you guys have done any research on these sort of companies, and what do you think like the prospect would be?
Yep. You're leading the witness here a little, Aaron, but I'll try and answer it a bit more neutral than that. I'm convinced that all of these companies, and especially Uber and Airbnb, will come to market pretty quickly. We've talked about Snapchat already, which is rumored to have registered for IPO. So all of these companies will come to the market, and we can have a closer look at what the valuations look like. The problem with all of those is that the road to monetization and accordingly the road to paying a decent multiple for it is always the hard one here. So they're all growing like crazy, and they're all creating big competitors as well, because they've basically created a new industry. This whole peer-to-peer space is obviously not only people like Airbnb and Uber active. So we'll have to see what they come up with. What I do note is that in the current climate, and I'm certainly looking at Snapchat here in terms of multiples, we are dangerously going back to 99 levels. So Snapchat is rumored to come to market for around 20 to 25 billion. This is based on around $200 million of revenues at the moment. So you're paying 100 times revenues, and I'm not talking about profits here because there are no profits yet. $100 million of revenues. Sorry, $200 million of revenues, a multiple of 100 times on that is just outrageous in my view. So we'll see how this all ends, but I have seen this before and it didn't end pretty.
Okay, we've got a few more questions that just came in. So we've got time for a few more. The question is, what's your outlook on the overall US equity market in the next 12 months?
Ooh, yuck. That's a tough one, because that really depends on what our friend Trump will say when he gets the Oval Office. That's really a hard one. What I do know is that fundamentally there are some really positive signs out there. We are starting to see some small inflationary pressure coming from wages. and most of the macroeconomic signals are pointing in the right direction, and certainly when you compare it to Europe or Asia. So from that perspective, I'm not overly worried, but if bad Donald becomes the driving factor versus good Donald, as we've discussed before, then we have an issue. Sorry to cop out on this one, but I'll come back to you in sort of mid-January.
All right, and our final question is, what are the immediate catalysts for NVIDIA?
Wow, that's an excellent question because they've actually just reported. The stock was up 30% on the day. Now normally that would worry me a little, but given the fact that the earnings expectations went up 30% as well, the PE multiple actually stayed the same. So that's always a very good outcome. The immediate drivers for NVIDIA are really twofold. So they are involved in the automotive business, as we've discussed before, and they've just signed a big deal with Tesla, and that's going to be transforming this business from a current $200 million level to a much higher number. So that's number one. The other factor is really all about data centers. And that sounds funny because this is a graphical chip company. But what they've discovered is basically that these graphical chips are much better at doing things like artificial intelligence calculations. So people like Facebook and Amazon, they all have lots of servers sitting in the data center trying to do hard calculations basically on all the data coming in. So they're trying to predict what their customers want and what their customers will do going forward. And some of them are quite successful in doing that. Now the computers running all of that calculations are these days being used with graphical processing units. And the reason for that is that it's a bit technical, but these GPUs use parallel processing versus a central processing unit, i.e. an Intel chip, that uses serial calculations, which is quite a different way of doing things. So data centers is a very big growth market, and the recent numbers showed that business is growing 200% at the moment, and there's no fear of that slowing down. So that will continue to drive the numbers up.
Cool. Thanks, Theo. I think that's all the question we have for today. Thanks again, everyone, for joining us today. A recording of the webinar will be sent to you after the session, and we'll also send a CPD questionnaire where you could then answer the questionnaire and download the CPD cert. Yeah, thanks again. Thanks, Theo, for your time. Thanks, Arnhem, to be involved in today's session, and we look forward to seeing everyone again in our next webinar. Thank you.